Gold didn't just rip. Gold just called out the bond market in public, and the usual narrative machine is already trying to wave it away as just another safe haven spike. But this move isn't emotion, it's math. And the math gets uglier the moment you look at what is happening underneath the headline price, because the hidden pressure is an T in the tweet stream. It's in the way money is moving through ETFs, while bonds can find a clean buyer at the margin. And if you stay with me to the end, I'm going to give you the exact 2-scenario roadmap for the next 1 to 2 weeks. What level matters, what confirms the thesis, what breaks it, and the one metric that will tell you whether this is a controlled retest, or the start of a continuation squeeze that gaps when nobody's ready. Here's the uncomfortable starting point. When bonds lose the bid, they don't have to crash to cause damage. They just have to stop doing their job. For decades, the classic playbook was simple. Stocks wobble, bonds catch a bid, yields fall, and portfolios breathe again. That's the old shock absorber. But when that absorber turns stiff, when yields stay sticky, auctions feel heavy, and buyers get picky, then the entire market has to find a different place to park fear. And gold is the oldest parking spot on Earth for that exact problem. But this time, it's not just retail panic buying coins. The structure is shifting. And that's where the real pressure starts. Let's ground this in right now context without getting lost in trivia. Gold has been trading at historically elevated levels and has recently been pushing into fresh record territory with big round numbers acting like magnets. Whether you focus on the psychological line in the sand, the speed of the rally, or the way pullbacks are getting bought faster than people expect, the message is the same. The market is treating gold less like a collectible and more like a balance sheet hedge. And speed matters more than the number, because speed changes who's forced to act. Fast moves don't just attract attention, they trigger positioning, margin, and hedging decisions in the plumbing of the market. And that's not the part most people are watching. Now let's talk about the titles tell. ETF flows turn up. That phrase sounds boring until you understand what ETF flows actually do in a metal market. A physically backed gold ETF isn't just a chart ticker people trade. When money flows in consistently, the ETF ecosystem expands shares through a creation mechanism. Authorized participants create new units. And in the process, the system needs exposure that is typically satisfied by sourcing metal or using hedges that translate into real demand for futures and spot. The precise mechanics can vary across products and how they hedge intraday, but the key idea is non-negotiable. Sustained inflows are a mechanical bid, not a vibe, not a narrative, a bid with a process behind it. And when that bid returns, at the same time bonds are struggling to pull in incremental buyers, you get a tug of war that the mainstream loves to oversimplify. But that simplification is exactly what gets people chopped up. Because if you want to understand what happens next, you need to watch the pressure gauges, not the headlines. Here is the hidden detail that reframes this entire story. The price can look fine, while the spread structure is quietly screaming. In metals, the term structure, how near-dated pricing relates to longer-dated pricing, can reveal urgency that the front-page price doesn't. When the front end tightens relative to the back months, when the market starts paying up for immediacy, it's telling you something simple in a language most people never learn. I want metal now, not later. That's not a conspiracy. That's logistics meeting finance. It's time value of metal, storage, financing costs, availability, and the willingness of holders to part with supply. And when that tightness shows up while ETF demand improves, you get a feedback loop. Flows press the system, spreads reflect the stress, and price eventually catches up to the reality underneath. And the next detail is what flips the whole setup. Because bonds losing the bid is not just a poetic phrase, it's a market structure condition. Bond demand is not guaranteed, especially at the long end, because buyers have to believe they being compensated for inflation, uncertainty, fiscal risk, and currency risk. When that belief weakens even slightly, you can see it in yields, staying elevated in auction tails, in the tone of demand, and in the way the dollar behaves when it should be acting like a vacuum cleaner for global capital. And recently, the US 10-year yield has been hovering around the low to mid 4% area. That number alone doesn't tell you everything, but it is enough to explain the portfolio behavior. If you are a large allocator and bonds are in T's, offering the kind of protection you were used to, you don't just sit in cash forever. You rotate, you hedge differently, you diversify, and gold becomes less of a trade and more of an insurance policy. But that's not the part that matters. What matters is the regime shift in correlation. In the clean textbook world, higher real yields should be headwind for gold, because gold doesn't pay interest. So when yields rise, the opportunity cost rises, and gold should get suffocated. That's the old model, but models fail when the reason yields are high changes. If yields are high because growth is strong and inflation is tame, sure, gold can lag. But if yields are high because investors are demanding compensation for fiscal credibility risk, inflation uncertainty, or global bond market stress, then higher yields stop being healthy and start being a symptom. And when yields become a symptom, gold doesn't have to apologize for rallying. It's doing its job. And that S, where the real pressure starts, because the market has to reprice the role of bonds in a world where governments borrow more, refinance more, and spend more, while investors become less willing to fund it cheaply. Now stack that with the ETF angle. The retail crowd tends to focus on price candles, but institutions watch flow persistence. A single day of inflow doesn't matter. A week can be noise, but a multi-week change in flow behavior, especially after a period of outflows or stagnation, starts to matter because it becomes a positioning problem. If ETFs are steadily absorbing demand again, that's not just more buyers. It's a reduction in free-floating supply available to satisfy dips. It's a change in the market's elasticity. And in a market where supply doesn't respond instantly, changes in elasticity can do more than fundamentals in the near term. Because if this one level breaks, the math changes. Let's hit supply chain reality for a second, because this is where the why now becomes credible. Gold supply doesn't surge because price surged. Mines can't flip a switch. Refiners can't teleport bars. Recycling responds, yes, but it responds on a calendar with frictions. Collection, processing, refining capacity, logistics, and incentives that aren't uniform across regions. In the short run, gold supply is relatively inelastic. That means demand shocks matter more than people think. And ETF flows are demand shocks that show up as steady pressure, not as a one-off panic. That's why ETF flows turning up is not a cute headline. It's a supply and demand event, and it gets more intense when you zoom out globally, because there isn't one gold market. There are many, stitched together by arbitrage, currency moves, and the cost of moving metal through the real world. When regional demand spikes, when currencies wobble, when capital controls tighten, or when premiums show up in places that normally clear efficiently, arbitrage tries to pull supply from one region to another. That's the global magnet. It can be slow, it can be messy, and it can be constrained by logistics and refining bottlenecks, but it's powerful. And when bonds lose the bid in one major region, that stress doesn't stay local. It transmits through FX, through hedging flows, through portfolio rebalancing. Gold becomes the global language for that stress, but that's not the part that matters. The part that matters right now is what this does to market structure. Because the moment price starts trending and flow starts supporting, the futures market becomes a machine of forced decisions. Shorts aren't villains. They're participants with risk limits. And when a market trends against them, the first thing that happens isn't some dramatic capitulation. It's incremental pain, higher margin requirements, wider intraday swings, liquidity thinning at the wrong time of day, stops getting triggered, and then, quietly, position reduction begins. That's short covering, and short covering is not bullish sentiment, it's risk management. A trader doesn't cover because they fell in love with gold. They cover because their risk officer told them to, and that's where the real pressure starts. Now layer in options, because this is where you get the reflexivity that can turn a trend into a squeeze. Here's the plain English version of delta hedging and gamma without the textbook fog. When traders buy call options, someone sells those calls. Often, that seller is a dealer who doesn't want to take directional risk. So the dealer hedges by buying the underlying gold futures, spot exposure, or correlated instruments, depending on the product. The amount they buy is tied to delta, which changes as price moves. When gamma is high, typically near big strikes with lots of open interest, small price moves force larger hedge adjustments. That's the feedback loop. Price rises, delta rises, dealer buys more to stay hedged, buying pushes price, delta rises again. This isn't a conspiracy. It's mechanics. And when that dynamic clusters around big, round strikes, those psychological levels everyone stares at, you can get pinning with sting behavior, or you can get acceleration. It depends on positioning. And the next detail is what flips the whole setup. The flip is the calendar. Markets don't move in a vacuum. They move through time windows where liquidity changes and participants are forced to act. Month end is not a meme. It's a real rebalancing and risk management period for funds, especially those with mandates that require them to maintain allocations. If gold has outperformed and bonds have underperformed, some portfolios are forced to rebalance. If volatility rises and bonds aren't cushioning, risk models can force de-risking elsewhere and hedging in different instruments. Add to that the rhythm of a treasury issuance and auctions, where demand gets tested publicly, and suddenly, bonds lose the bid becomes a near-term catalyst rather than a slow macro story. Then you've got options expiries, futures rolls, and delivery windows that can tighten liquidity and make the front end more sensitive. That's why now. Not because the universe woke up and chose drama, because the calendar compresses decisions, and that's where the real pressure starts. So let's do what finance people actually do. Proof stack. Not one argument. 5+ pressure gauges that point the same way. First, flow behavior. Are physically backed gold ETFs stabilizing after prior softness, and are inflows appearing more persistently rather than as a single-day blip? Second, term structure and spreads. Does the front end show signs of tightness relative to the back months? Any hint that immediacy is being valued more than future delivery? Third, bond tape. Do yields stay stubborn even when risk assets wobble, and do auctions or demand signals feel heavy? Fourth, options positioning. Are there clusters of open interest at major strikes that can create reflexive hedging if price pushes through? Fifth, physical symptoms. Premiums, availability chatter, and the behavior of wholesale demand in key regions. Are there signs the physical market is not as relaxed as the paper price suggests? Sixth, because we're not stopping at 5, global comparison. Does the move show up across currencies, or is it just a dollar story? If gold is breaking out in multiple currency terms, that's not just USD weakness. That's a broader bid for the metal. When those gauges line up, it stops being a narrative. It becomes a structure, and the next detail is what flips the whole setup. Now, the skeptics are right to push back on one point. If ETF flows are the story, why do we sometimes see outflow weeks even during rallies? Because flows are not a metronome. They're a reflection of investor behavior across time horizons. You can get profit-taking outflows on a strong week and still be in a bigger trend of returning demand. You can also get a divergence where price rises on futures-driven positioning while ETF holders sell into strength. That's why you don't bet your sanity on a single weekly print. You watch persistence, you watch direction, you watch whether dips are bought and whether the market structure tightens, and you watch how bonds behave in the same window. Because if bonds regain the bid and start acting like a hedge again, gold's urgency can cool. That's your invalidation path, and it matters this week. Let's translate all of this into what it forces participants to do. If gold keeps pushing through big psychological levels, short positions face rising margin pressure and risk limits get tested. Dealers who are short calls hedge by buying, which adds a mechanical bid in certain zones. Funds that benchmark allocations may rebalance at month end, which can create predictable demand. Meanwhile, if bonds don't catch a bid, investors who relied on bonds for stability look for alternative hedges, and gold is the simplest. None of this guarantees a straight line up. Markets don't reward certainty. But it does create a setup where pullbacks can be shallow and violent moves can appear out of nowhere. And that's exactly how people get emotionally manipulated. So let's put the psychology shield on right now before you get whipped around. The market doesn't need you to be wrong. It just needs you to react at the wrong time. Volatility is a weapon because it triggers the two dumbest human impulses: chasing strength late and dumping weakness early. If you believe the gold thesis, you still have to respect that price can whip around violently even if the thesis is correct. Trend signal and noise are not the same thing. Noise is intraday chaos, stop runs, and headline spikes. Trend signal is the behavior of flows, the behavior of spreads, the behavior of bonds, and the market's reaction to catalysts. If you treat noise like signal, you will donate your account to the market. If you treat signal like noise, you'll miss the move entirely. So you need a framework. And the framework for the next 1 to 2 weeks is simple: 2 scenarios. Scenario 1 is the controlled pullback and retest. This is the disciplined path. Gold pokes above a key psychological zone, stalls, then pulls back to retest a prior breakout area. In this scenario, you'd expect dips to be bought, but not instantly. There's a little time for weak hands to get shaken out. Bonds might stabilize slightly, yields might stop climbing, the dollar might firm, and the gold market cools without breaking. What confirms this scenario is the behavior on the retest. Does price hold a clear support band? Do spreads stay relatively tight? Do ETF flows remain stable rather than flipping aggressively negative, and does the market refuse to go down on bad news? That last one is huge. Markets that refuse to drop on scary headlines are usually stronger than they look. What weakens this scenario is a clean break below the retest zone with no rebound, combined with bond demand improving sharply, meaning bonds regain their hedge function, and ETF flows fading. That's your "the setup is cooling" signal. Scenario 2 is the continuation squeeze and gap risk. This is the punishes hesitation path. In this scenario, price doesn't give the clean pullback everyone wants. It compresses, then lifts, then runs through the next strike clusters and round numbers, forcing dealers to chase hedges and shorts to reduce risk and to thin liquidity. You'll see it as sudden bursts, 2 or 3 strong sessions where the move feels unfair, where people say it's too far, and it keeps going. What confirms this scenario is acceleration with structure. Rising price alongside signs of persistent flow demand spreads that don't loosen, and bonds that still can find clean sponsorship, meaning yields stay sticky and risk off doesn't translate into a big bond rally. What invalidates this scenario is a failed breakout that snaps back hard below the breakout zone and stays there, especially if it is accompanied by a meaningful recovery in bond bidding and a shift in narrative from fiscal stress to stability regained. If bonds start acting like the old shock absorber again, gold can still be bullish longer term, but the squeeze dynamics fade. And that is where the real pressure starts, because most people can to separate thesis still true from timing just changed. Now, let's talk levels without pretending we have a crystal ball. In markets like this, the most important levels are the ones everybody sees because they concentrate positioning. Big round psychological numbers act like magnets and tripwires. Above them, you often find air pockets where price can travel faster than people expect because there is less sell interest and more forced hedging. Below them, you often find the retest zones, prior breakout regions where buyers either show up or don't. So your job this week is not to worship a single number. Your job is to watch behavior around levels. Does price break and hold or break and fail? Does it retest and bounce or retest and slice through? And when it bounces, does it bounce on volume and urgency, or does it drift? That's how you keep yourself from getting played by the tape. Here's the checklist for the next 7 to 14 days, the stuff that matters more than opinions. Watch ETF flow cadence, not one-off prints. Are they stabilizing? Are they turning positive more often? And do drawdowns attract fresh allocations? Watch the bond market's willingness to absorb issuance and risk. Do yields stay stubborn? And does any risk-off episode fail to produce a strong bond rally? Watch term structure behavior. Any sign that the front end is tight relative to the back end, implying urgency for near-term exposure. Watch option zones around major strikes. If price approaches a heavily trafficked area, be aware that dealer hedging can amplify movement. Watch currency stress. If gold strength persists across currencies, that signals broader demand beyond a simple USD move. And watch liquidity windows. Month-end, policy headlines, auctions, and thin sessions can turn small imbalances into big candles. Because if this one level breaks, the math changes. Now, a necessary counterpoint, because credibility matters more than hype. Gold can be overextended on a short-term basis. Profit-taking can happen fast. A single geopolitical headline can reverse in a day. A hotter-than-expected inflation print can push yields up and trigger a temporary gold dip, and ETF flows can wobble. None of those points kill the thesis. They just remind you that timing is a knife fight, not a seminar. The way you protect yourself is by refusing to anchor emotionally to a single outcome. You hold the two-scenario lens, you define what would confirm and what would weaken, and you size decisions to survive volatility, because survivability is alpha in a market like this. So what's the real takeaway from ETF flows turn up as bonds lose bid? It's not that gold is going to the moon, it's that the market is repricing the hierarchy of safety. When bonds are unquestioned, gold is optional. When bonds are questioned, gold becomes necessary for some portfolios. That's not ideology, that's risk management. And when that shift meets the mechanical reality of flows and hedging, you get moves that feel sudden because the groundwork was laid quietly. The price is the last thing to show you the truth. Spreads, flows, and bond behavior whisper it first. And that's where the real pressure starts. If you've made it this far, here's the subtle CTA, and I mean subtle. Don to be the person who only shows up when the move is already on every 1S screen. Be the person who watches the plumbing, who tracks the flow, who respects the calendar, and who doesn't let volatility bully them into panic decisions. Stick with the process. Watch the pressure gauges. Talk with people who care about mechanisms, not just memes. That's how you build an edge without needing a perfect prediction. Final thought. The one metric I want you to burn into your brain this week, the relationship between persistent gold ETF demand and the bond market's ability to actually attract clean, incremental buying when it's tested. When those two are moving in opposite directions, gold demand firming while bond sponsorship feels shaky, you know it. Are we in a regime where gold strength can sustain longer than people expect, and squeezes can emerge faster than people are positioned for? If that relationship flips, if bonds regain the bid convincingly and flows fade, then the near-term heat comes off, and you switch from squeeze risk to retest risk. That's not bearish, that's discipline. And discipline is what keeps you from getting used by volatility. Watch the flow, watch the curve, watch the bond tape. And when the market tries to bait you into an emotional decision, remember, they don't need you to be wrong. They just need you to react at the wrong time.